Hage needs a 2-putt bogey to win here on number 72 at the Rusty Putter in St. John. Ooh. He zips that one past the hole, and with that tap in, another 3-putt puts Hage and Perri score through 72.
Hey,
look at that.
We are back.
We went with the old school opening in honor of my son and his fear of ghosts. So we go with the horror story.
Yeah.
Adam, what's going on?
Well, we got a big meeting today, I heard. Everyone's been talking about it.
Oh, what are you guys talking about at the office this afternoon?
Well, I meant we as in a country.
Oh, yeah. That guy, Jeremy, he's speaking?
Yeah. What's his deal?
I don't know. I think we maybe took a couple of pot shots at him last week. They probably are shutting down the studio on us.
Yeah.
But, so Jerome Powell going to have the Fed Open Market Committee press conference later this afternoon. And the rate.
Yeah, everyone's talking about it. They're going to cut the rate, but how much are they going to cut it?
And this magic rate, what
is
exactly is this rate?
What is it actually? What is the federal funds rate?
So the federal funds rate, if I was boiling it down to you,
okay,
and you were in second grade,
okay.
or
I can pretend that really easily,
or anywhere between second grade and 45 years old.
Same.
Pretty wide range there. Federal funds rate is what banks, the interest rate on what banks lend other banks money overnight.
Okay.
So every night a bank, they go through the balance sheet and they have to have an appropriate amount of reserves on their balance sheet.
Got it.
So if they're a little short here, hey, I'm going to call the Bank of Adam. Hey, it's the Bank of Tony. Bank of Adam, I need to borrow some money.
Tony's a little short. Adam slides over, a bill.
Yeah, just a quick billion.
And then I charge you to have liquidity.
Yes.
And I don't get to set that rate.
You don't set that rate.
The federal government sets that rate.
They set a range. So there's the range of rates, and then there's the real whatever we transact at. But why does that actually matter to the economy? Why is there so much concentration on it? Well,
I don't know. I'm in second grade. I just want fish sticks.
Exactly. And when you're in second grade, all you do is you want to click on that interesting thing, right?
Uh-huh.
So if all you see is Paw Patrol, Paw Patrol, Paw Patrol, and then you see new Paw Patrol.
Yeah, you got to get that.
Right? So Paw Patrol, the rate.
The rate.
Whatever. What's it?
But why is it important? Okay, so I get it. So I'm charging Bank of Tony, whatever the rate is, 4 point whatever, to hold on to my money. And then the government's going to say, this is how much you can charge. But how does that trickle down to us?
So think about this. If you are going to have to borrow money from me at 5.25% overnight,
yes,
right? You're probably going to be more inclined to keep cash in reserves on your balance sheet versus lending them out.
So Bank of Tony was short. And so instead of having to borrow from Bank of Adam at 4.5%, Bank of Tony tomorrow might not give out as much money because now Bank of Tony is having to pay to give that money out. So less money is getting put out into the market.
Less money is being lent to consumers, to businesses, commercial lending. So when the Fed funds rate goes down, that's why you'll also see your CD rates will probably go down.
Mm-hmm.
Your saving, if you just have a regular money market account, you're going to see those yields go down because they're trying to encourage banks to lend.
So the borrowing is getting cheaper for Bank of Tony. So if they do this today, if they lower that rate, Bank of Tony might be more inclined to lend more because it's cheaper to borrow in case he gets sideways a little bit.
Yeah.
That sound right?
Sounds about right.
Wow.
Look at that. Taught it to you in 2 minutes and 15 seconds.
We figured it out. So this is cool because, more money into the environment, but into the market means that lending becomes more free, which means more development. You might be able to get that loan, but how does that translate to a mortgage, or does it?
So there's this misconception of the actual Fed funds rate having a direct correlation to your 30-year mortgage rate.
Yeah, because I think if everyone hears that the rates are going down, they are assuming that a mortgage rate is going to go down. That may or may not be correct.
I'm not sure when that kind of broke, that system of the assumption of the rate.
Yes.
But I mean, the problem is that the media advertises it as the rate or the rate if you go to Ohio State University.
Yeah.
Big time, baby. But there's this, it's a fixation on this. And I think what's going on in an election year, we're 2 months, 2 months away from an election. We're looking for that boogeyman. The media is looking for that boogeyman. The current, and I wouldn't say the current administration since he's not running again, but the incumbent party is looking to deflect
the state of the market.
Yeah, the market in general, right? We've had this crazy run up in home prices.
Yes.
Interest rates mortgage rates didn't cool that price acceleration down.
Mm-mm.
But what's being buried? Like, what are some numbers that have been revised, right? We've had the jobs number revised to almost cut 1 in 3 jobs that were supposedly gained in the last year. Didn't actually happen. So realistically, the affordability issue is inflation and lack of wage growth, which you have, when you buy a house, I always talk about going to AA, appreciation and amortization, value of house going up, loan balance going down, right?
Yes, that's a good place to be.
That is the good AA. I mean, regular AA is not bad too.
That's also good.
But it's a 12-step program, Adam.
Sure.
You have to get in at some point, and you have to realistically look at yourself and go, when do I want to get into this 12-step program of appreciation and amortization? Well, all of a sudden, if you continue to increase the barrier for entry, well, you're still getting that appreciation, but the amortization rate slows up a little bit because now you're borrowing more at a
higher rate.
Yes. Yeah. So, okay, we cut the Fed funds rate, right? So what does that really mean?
Yeah.
It means the Fed's actually trying to stimulate the economy.
So they're saying we don't want the economy to stall out. So the economy went crazy when they injected all that free money from COVID, right? Went nuts. It's like an overheating engine. And then they're like, hold on a second. We got to slow this thing down. So the only levers they have to pull are, well, there's multiple, but the Fed funds rate goes up. So that should, in theory, slow down money being injected in. And so that's why they're looking at inflation numbers that
the Fed, like them raising and hiking the Fed funds rate, which to the extent that they did, was unprecedented. Like it's not something that we historically have seen. And we also haven't seen, outside of the 1980s, we haven't seen inflation jump the way that it did. They had to fight it because when money's cheap, people, things get more and more expensive because it's cheap. It's easy to come by.
Yeah.
Now we tighten monetary policy. Money's a little more expensive. Well, prices still continue to go up.
Right. But
then they hit a theoretical ceiling. Now we're stuck in this weird spot of where do rates go? And so the Fed funds rate itself doesn't have as much correlation with mortgage rates as a consumer or anyone would really think. But longer run, there's bigger market movement that will dictate that. So realistically, what we want to see is if the Fed's going to say, hey, we're cutting rates by a quarter, or we're cutting rates or the Fed funds rate by a half, we want to see what the other pieces of the marketplace are going to do.
Okay.
So for mortgages specifically, what do we see the 10-year treasury yield doing after that? Right. And what do we see the 2-year treasury yield doing after that? So we've had conversations like this before, and I've had conversations with a lot of customers. How come a 15-year rate and a 30-year rate is nearly the same for the last 5 years?
Why is that?
The 2-year treasury yield and the 10-year treasury yield were inverted. What does that mean? They're backwards. Shorter term money is more expensive than longer term money. It's ass backwards.
Yeah.
But that's what happens when you pump in a bajillion dollars into the marketplace for longer run borrowing costs.
Right.
So think about it. Like, would you take a 15-year mortgage if that rate difference was only a 0.5%?
No, I would never take a 15-year mortgage. I don't think anyone should ever pay off their house. But that's just me. But no, yeah, you're right. So even if it was the same rate, why would you? You're going to pay. It's the same rate.
Yeah, I usually tell people that you don't want to jump from a 30 to a 15 unless you're getting a 1.5 difference. So a 6 versus a 4.5.
Right.
Like that seems to be the threshold.
So boiling this down, so the Fed funds rate, they're going to cut it. And so people are speculating right now, right? So they're saying, is it going to be a 0.5 point? Is it going to be a 1/4 point? And by the way, that doesn't mean a point is 1%, right?
Yes.
And a basis point is 1/10 of that. So they're saying, is it going to go up go down a 1/4 or a 1/2? And then people are betting on that. And if it's a 1/4, maybe the stock market doesn't go up as much. I think it's just like crazy how much
it's literally, I thought, we were talking about how to address this episode. And I was like, all right, we'll call it like Pearl Jam. They have the song Jeremy. We got Jerome Powell. Pearl Jam just played at Wrigley Field recently. So tying it all in. But you ever seen Pearl Jam live?
No, man, I missed it.
All right. So I saw him, I don't know, it was probably like 7 or 8 years ago at Wrigley. Eddie Vedder, there's YouTube videos. People are like, what is he even talking about? Because he just kind of mumbles. He's like Ozzy Osbourne. Right?
Sharon.
Jeremy. I see dams.
Yeah.
And it's just all of this mud and this muck and confusion for people. And it's like, okay, so the Fed funds rate, what does that actually mean? Well, that's the Bank of Adam lending money to the Bank of Tony overnight or vice versa, right?
Yes.
So that doesn't have a specific correlation on Adam calling Tony and saying, hey, Tony, I need a mortgage, right? Longer run, though, what does that potentially mean? Well, does it mean that your company, the mutual portion of the company that you work for, if their cost of funds go down, does that eventually allow them potentially to reallocate some risk and maybe extend some risk and lower some premiums in the next 2 years?
Could be.
Potentially.
Hopefully.
Does it mean that all these other companies that are relying on financing, so the construction companies, the materials companies, and everything else, does that drive down the cost of repairing a house after
or does it allow them
to
maybe build more houses, which if there's more inventory, now the prices come down. So this is just like one little part of an economy. So it just feels like everyone's putting so much onus on what Jeremy's going to speak in class today. Like, what's it, Jeremy?
He gnashed the teacher. What he bit the teacher somewhere?
He did.
We don't know exactly where he got bit, but I think that the media has hyped this thing up, and part of it is, again, we talked last week about, hey, getting that shot of steroids, right? Like I'm on the cycle of D-bol, and now my biceps are like this.
Yeah.
And you end up Mark McGwire, Sammy Sosa hitting 70 home runs, and then Barry Bonds hitting 73 or 74.
Right.
And then you all of a sudden, right? Look at MLB. If we look at reactionary things, right? We take that shot of steroids, and then we go to 3.5-hour games, people hitting 190 and still being on major league rosters.
Yeah.
And you don't see 70 home runs anymore.
No.
Like it's you all of a sudden you pull some stuff back and things change. But then baseball adapts, right?
Right.
We put a pitch clock in.
So the economy is just this thing that's always changing. So it's like people are going to compare it to, I think, whatever the best part of their life was in the economy or whatever it is. But things have changed so much that you got to start looking at different stuff instead of just looking at one measurement. Is that what you're trying to say?
Yes.
Yeah.
We are we can pull up this chart and show it here in a second, but you and I were talking before this, and I actually had a lengthy conversation with a customer yesterday who had some questions about wanting to refinance his house. And I was like, the mortgage industry, and I was just after last week, ran up to Milwaukee for our corporate managers meeting. The mortgage industry has fundamentally changed after COVID.
Yeah.
And for lack of a better term, we used to be able to make $5 selling a cheeseburger. Mm-hmm. And now the entire market can only make $2.50 selling a cheeseburger. And it's no different than 2x4s.
Right.
They used to cost 89 cents. They now cost $4.
Right.
They're never going to cost 89 cents again.
No.
So for mortgage companies, our top line revenue has been clipped in half, and it's not coming back. The market just is not going to allow for it.
Right.
Because we're not going to see that steroid injection. We're not going to go see who's the guy that used to like A-Rod and Barry Bonds.
Yeah. He used to go see him, shoot him up at the gym or whatever.
Yeah. We're not, so like realistically, right? So a 25 basis point or 50 basis point rate cut, right? Is that the clear or is it the cream for Barry Bonds?
Like
we don't know which way. We just know that 72 home runs are still going to get hit.
But what it is indicating is what they're going to be doing. So like if they've gone to this thing where they were raising it to slow down everything, and now they're looking at, okay, we're going to lower them and start looking in that direction to have more loose monetary policy. So it's just indicating what direction that it might be going. But is it going to lower your mortgage rate, quote, tomorrow?
No. You're because in the last 2 weeks, right? We've seen the market, and you talk about trading and betting on this. You can legitimately take a position, not on DraftKings or sports, any of those ones, but there is a Fed funds rate futures market.
Yeah.
So you could take action on it. Well, all of a sudden, we've had a 1/4 point rate cut baked in the market for the last 3 months.
It's already in here.
Last week, all of a sudden, there's this huge movement to it went from like a 0% chance to a 61% chance of a 50 basis point rate cut, or 0.5%.
Yeah.
Well, and I think it's because we all of a sudden, right, we get the big ticket inflation numbers have come in line 3 months in a row. Employment market still seems to be full. I don't know if that's real or not, quite honestly, but it is what it is. That's what the Fed follows. So now what are they doing? They have to make a decision because they want the term soft landing, right?
Yeah. They don't want it to crash out.
So. Exactly. I mean, you don't want to be sitting 100 yards out and you catch one thin and you shoot it. You're on the backside of a green, or you're in the back of a greenside bunker. Yeah. Chipping downhill.
That's an automatic bogey.
Exactly. And then you're chasing putts uphill, right? So they want to try to land this within 5 feet and have it happen.
Interesting is like how like they're not able to speak. Like they go in like a blackout. Like, so these guys can't even talk to like their friends. Like they just, because whatever they say, like we'll move a market or change the line on a bet, which is the bet of, do the Fed's fund rate goes up or down, or whatever. It's just an interesting like calamity of whatever they're doing.
Oh, and so so what we're going to expect to hear, right, in the presser and then in the minutes release, there's people like linguists that are basically parsing every word.
Yeah.
So what did they say about long run, short run? Is there headwinds? What is the Fed nervous about? Because a couple weeks ago, Jerome Powell said we have to adjust policy.
Yeah.
The policy. So now we got the policy in the rate.
And what does that mean? What does he mean by that? Well, then people are just betting, which is all this really
My policy's going up?
Yeah.
My policy's going down? It's very, very technical stuff. What we have to do is we have to boil it down for people so it makes a little more sense. We see a 25 basis point rate cut. Okay, great. Like that was baked into the market 3 months ago. That's not going to.
So nothing changes.
Yeah.
But if it's more than that, then the market's like, holy cow, we're getting more fuel injected. Let's go.
Well, that's the scary part, right? Is like you have all of these large banks sitting on a lot of cash right now. Well, all of a sudden, hey, that Fed funds rate went down. Let's go buck wild and throw all of our money back into equities. So now you see the S&P and the Dow run up. Well, when those markets run up, believe it or not, there's a finite amount of money that exists.
Yeah.
But it's probably infinite because you keep printing it.
Print it.
But hey, Sabrina, what are you doing with the printer? You got some hundreds coming out. But you have the market shift back towards equities. It pulls money out of fixed income. Fixed income is what makes the mortgage world go around, and it's what makes the insurance world go around.
That's correct.
So now you don't have liquidity in the fixed income market. Does it actually prop rates up? Does it create issues for insurance companies potentially on their cost of funds?
Yeah, bonds, all that stuff. But
yeah, it's literally a Pearl Jam song. Just and then you got Eddie Vedder fighting Ticketmaster, and we're out here fighting the Fed.
Yeah, bingo.
Want some steroids?
No.
And if we're really looking at this from a casino standpoint, this is like the Fed right now. This decision is we got a 16 against a dealer 7.
Yeah.
And there's no real play on it.
You're supposed to hit. The book says hit.
The book says hit, but
it's also, what do you feel? So that's interesting. Wow.
And I mean, it's the unfortunate part. The American economy is basically the casino.
Yeah. Just we got right back down to it. We're betting on life.
and please don't spend your down payment money on
don't do that.
That's also not a good
don't
spot
put
for
it on
insurance
black
premiums.
Yeah.
What else have we seen in the insurance world here?
I think we were supposed to have a meeting about the flood insurance program. I don't know if they funded it or not. I have to look at that. Hopefully we're through. If inflation in fact has stopped, hopefully we'll see these rates at least not go up too much more. But it's pretty much the same. Like it's just trying to keep. We're also seeing a lot of regional carriers not be able to write. So like you're going to see homes that have flat roofs that aren't eligible for insurance. Like
so we say a regional carrier, are you talking like a smaller?
Yeah, like someone who's a smaller, not national. So they're not. So when like a big hailstorm hits the Midwest or a big like flurry of storms, they're not as able to absorb those losses because they're so specific. Like the risk is so finite into this region. Where like a company like ours is so big that if something happens in South Carolina, it's okay because our finances are spread out through Wyoming. But if you don't have exposure where there's no storms happening, you're in big trouble right now. Big trouble. And
the government's still looking to maybe intervene in the insurance markets, which is never a really good thing.
Yeah. I saw some article about, Susie Orman is going to self-insure her condo and blah, blah, blah. And she goes on this rant about, well, the insurance companies are just going to fight my claim anyways. Like, well, no, Susie, like your condo is literally about to fall in the ocean. You shouldn't have a condo there. So yes, your insurance is going to be expensive. That's just how it works. But that's it. So that's what's happening.
Think about I was thinking about this too, but obviously football season started, right? Mm-hmm. What's an insurance policy? The offensive line?
No. I mean, it could be.
Wouldn't you pay a quarterback a lot of money?
Yeah, I mean so if you're looking at the offense, the offensive line, the insurance on that would be the offensive line. But I think as the whole sport, I think it's your defense, which we can score touchdowns, right? I mean, the Bears, the only thing they got going is a defense.
Yeah, exactly.
So, yeah.
I think if you were playing fantasy, if you took the Texans defense and special teams the other night with their kicker just bombing 55-yard field goals.
It's amazing how they can make field goals from like 60 yards now. It's insane.
Everything's changing.
Yeah.
Prices have changed, right?
The kickoff changed.
It's the most.
What do you think about it?
I don't even know how to understand it.
I feel like if Devin Hester was in the league right now, he would crush. All he needs is like 2 blocks, and then like he can get outside and he's gone.
Soldier Boy, tell him.
Right?
That you knew as soon as Soldier Boy came on at Soldier Field, it was Hester was taking one to the house. Yeah, I mean football. We're about 2 weeks in Northern Illinois. Those Huskies.
That's awesome.
Big ol' upset. We have 2 teams. U of I also in the top 25 right now.
That's amazing.
Yeah, not much of a football state over there normally.
Where did NIU end? Are they in ranks?
Yeah, they're 25. they're 25 and Illinois is 24 maybe.
That's awesome.
Real quick though, we'll kind of. I think this chart is about as colorblind as me.
Are you colorblind?
Yeah.
Never even knew it.
That's why I can never find my golf ball.
Oh, that's what it is.
The white golf ball and the green grass.
He hits yellow balls.
Well, it's underwater, so I didn't bring my scuba gear. But these are, and again, this is not in color, but the bottom line here is the Fed funds rate. So we don't really see, from 2010 to pretty much 2015, 16 here.
It was free money.
Flat. It was less than 0.25%. But you then follow the 10-year Treasury and then 30-year mortgage rates. There is not a specific correlation. I don't know if you're a chart guy, but I'm guessing you probably took some economics classes in college. There's not a specific correlation here between Fed funds rate and mortgage rate. You see a way better correlation between the 10-year Treasury yield and a 30-year fixed rate.
Yeah, you see a little bit of a relationship there, but it's not directly.
It's a lot tighter, but right. So now we've talked about we just got to clear the cream. It's not. Who's that guy? I can't even think of the guy's name right now.
Which guy?
The steroid guy. Yeah,
I forget his name.
But we see this. That we come out of the injection of steroid, right? And you see the Fed funds rate bounce up at a level that's nearly parabolic, right? You see the 10-year Treasury bounce up. And then you also see 30-year mortgage rates climb to a level they have. And then all of a sudden, right, the Fed funds rate stays the same for the last little while here. Well, we finally start to see mortgage rates trickle down.
Yeah.
So they're getting back. But like if you follow this, there's the correlation is the 10-year treasury. It's not the Fed funds rate.
Right.
Now, Fed funds rate makes an adjustment, then the 10-year treasury yield likely makes an adjustment. So don't get hyper focused on it. I guess at the end of the day,
that's the message. It's just like everyone's talking about it like, oh, the rate. Well, dude, that's just one little piece of this thing. There's an underlying economy underneath that really drives everything. They're just trying to manipulate it with this little tool they have.
Yeah, I look at it like, if you need gas, are you gonna wait for gas to like, oh, OPEC said that they're gonna produce 10 million more barrels next month. I won't get gas for a month.
Yeah, no, that doesn't happen.
It doesn't happen. And I think what we're starting to see here, and there's this other fear right now of the next administration talking about capital gains and all of that. I have seen more landlords decide that they're selling their houses than I've ever encountered. And it's been a pretty toxic relationship. I've had a customer right now, he's a mutual customer of ours. He's closing on a house next week. He's been renting that house since 2004.
He just doesn't want to mess with it anymore. Can't make money on
it. The landlord said, we're selling this house. Yeah. Like, you have to go. And he was paying below market rent. So you've had insulated below market rent for 20 years. And now you're getting thrust into the next environment, like the next step.
Yeah.
You have to take control of that.
Right.
We'll get on it with this. So I saw like the whole, getting in and depreciation and amortization in the 12-step program. I think if you actually looked at building your wealth and building stability in your finances, it is probably a 12-step program. Buying your dream house as your first house is not realistic.
No.
Buy something that you can afford, that fits within your budget. Yeah, is it going to be maybe a little bit outside of the marketplace that you really, really want to be in? Yeah, but it allows you to gain control. And now all of a sudden it's like a negotiation, right? I gain control. So now I have control of safe, sustainable, suitable housing. My family grows. Well, I can take this asset and flip it up into another asset.
Mm-hmm.
I don't know. I mean, if I looked at my first car, it was a 85 El Camino.
Nice.
And my first house was...
Is the El Camino the one that's like a car, but it's a truck too?
It was, yeah. It lasted for 3 weeks. I blew the motor on that thing in 2 seconds.
What'd you put in the back of that truck?
Kegs. Kegs. And actually, I had rope lights in there.
Oh, wow.
Pretty sick stereo. But like, I also look at my first house was $65,000 or $68,000. Like, and it wasn't pretty. It was ugly, and we learned how to fix it. But it was that step that allowed me to the next step, that allowed me to the next step, that allowed me to the next step.
Yeah.
I don't think you take one giant step and land where you want in most cases. Yeah. Probably same thing for you, right? Same. What was your first car?
It was a 1992 Jeep Cherokee Laredo, white.
Oh, man.
And my sister crashed it. I love that car.
It was hopefully it was properly insured.
It was.
All right. The old family car crash. It's always a fun one.
Yeah.
I had 92 Ranger after that El Camino. That was I think they put 400,000 miles on it.
Yeah.
But that's, we talk about some of the other things like car costs, everything's gone up. I will tell you this, right? One of the craziest things in the mortgage world is about to pop up. The new iPhone coming out. For the love of God, don't spend $1,600 on the phone.
That's how much the iPhone is?
I think it's like $1,400 or $1,600. But they put you on the payment plan now.
Well, it's free, but then they charge you. That's what they do.
Yeah. So now you have a $120 phone bill plus a $40 a month, whatever you want to call it, hardware fee.
Yeah.
And it's just a trap to catch you in that payment. Don't fight against that stuff. And then the last piece, all right, we've rambled on this one, but I can't stress this part enough. There is a massive difference when someone's talking to you about refinancing between no cost and no cost out of pocket.
Yeah, there's always a cost.
Exactly.
Where are they hiding it? That's the thing.
So, I mean, if someone's advertising to you a no-cost refinance, when you get your loan documents, you should expect your loan amount on your new loan to be what your payoff is on your old loan. and then bring $0 to closing.
Yeah.
I promise you that does not exist at these low interest rates that these services are calling you at.
No, they have to make money. I mean, there's got to be a fee.
I mean, it's exactly that, right? And now factor in that with, we probably have some escrow shortages with homeowners insurance going up, real estate taxes going way up. So now is a great time to just look at your budget, but don't refinance just refinancing it in 4 months. It's not, that doesn't make sense. Talk to someone that will put you on the right plan, and it is not just that desperate to sell you to save $80 a month.
Exactly.
I could probably find $80 a month in almost everyone's budget that could get cut out before you got to worry about spending $3,000 to refi.
Bingo.
Anything else?
No.
What next week? I believe we have the crack man on.
Cool.
I believe Larry Rossi from Relied is going to be.
Oh yeah.
I think it's next week. I gotta look at the schedule. So we are going to in studio have a crack dealer.
He is.
He's going to bring the crack. We're going to talk about cracks. You can text him pictures of your crack.
Cool.
But yeah, he'll be on. It'll be a great conversation.
I'm sure he does need a picture of the crack before you can fill it.
You always want to know what you're aiming for, right? And before we get kicked off all of media platforms, I think we're out of here. Adam, they can get you at Adam is my agent. Adam at adamismyagent.com.
Bingo.
Applywithjr.com. Stay tuned this afternoon here, but don't stress about it. It really is not going to mean anything to you.
No. Whatever they do, it's all good.
Jeremy is speaking.